Hello and good evening, everyone, and a very warm welcome to the webinar. Thanks for taking the time to join us today. In today's session, we'll be discussing a topic that is about to become very relevant for all companies in India, Ind AS 118, and what it means for financial reporting for companies that need to adopt it. I am joined today with a few of my colleagues. I have Sameer Malik, who leads our technical accounting. I have with me Manish, who brings in the tech dimension. He leads our enterprise applications. I also have Meenakshi Sharma, who leads our investor relations offerings. And the reason we have my colleagues, my more than capable colleagues here today is because the standard brings in a lot of dimensions beyond accounting, some of which we'll uncover today as we go along. So without further ado, I think let's start the webinar. Ind AS 118, as some of you may be aware, is the new presentation standard, and it actually goes beyond what we report in the financial statements in terms of its implications. It's not just about where certain items sit in the profit and loss account, but it's really about how you define your performance, explain it, and communicate it to your investors and other stakeholders. And those stakeholders are, quite a few, while obviously the primary impacted stakeholders are CFOs and finance functions who need to now understand the standard and its implications and implement the change. But you also have, auditors who need to be able to attest to this change and ensure that companies are complying with it in spirit. You have the regulator who needs to make sure that the transition is seamless and allows for greater comparability across our companies in India and around the world. And I'll be talk a bit more about that. And last but not the least, you have investors and external stakeholders who look at companies and their performance, and for whom this is going to be a significant change in terms of the way companies present their performance and the metrics that they now are required to produce and present in their financial statements. I think if we go ahead, and then you should get a sense of what we're going to talk about today. But Ind AS 118 and its global equivalent IFRS 18, I think it's one of the most significant changes that has happened in the financial reporting world in the recent past. The standard itself has been under development for about 10 years, and that should tell you about the amount of effort and the amount of deliberations that have gone on in defining and finalizing what is now the final standard. And I'm referring to IFRS 18, which is where Ind AS 118 is derived from. In its original form, it was actually meant to, also require changes to how balance sheets are presented. But the final standard limits itself to talk about how companies will now need to present their profit and loss account. And it's quite interesting because quite often you would hear that the profit and loss account is now going to look very similar to the cash flow statement in terms of the categories. And I'm referring to how your income and expenses are classified on the face of the profit and loss account. But while that is true in terms of form, the underlying wiring, the underlying groupings, the underlying how you are going to bring these items and how you define these items are very different. And that is essentially based on what are called main business activities. The standard requires companies to reassess why are they in business, and that in turn defines what should be operating, investing, or financing. Interestingly enough, operating is a residual category, and Sameer will talk about that and explain that in a few minutes. It also talks about how your income and expenses should be classified on the P&L. And I think one of the fundamental differences between how India adopted Ind AS versus how the rest of the world was following IFRS was the classification of expenses. And this standard now will allow companies to have a choice of presenting expenses either classified by nature or by function, which again will require some serious deliberation and thought in terms of what allows you to better represent your financial performance. There is also a very significant component of the standard that talks about management performance measures. What are management performance measures? How should they be presented? And the genesis for these it is really what are in common parlance called non-GAAP measures. Quite a lot of companies use various metrics to represent their business performance, their operating performance, their financial performance. And historically, these have been, presented in various parts of the financial statements, in various parts of the annual report. Some reside on the website, some would be present in the investor presentation, and then so on. And I think one of the most significant changes this standard will bring about is requiring these measures to be now presented in the audited financial statements. What does that mean? How will you adapt to that change? Is there a requirement for you to revisit some of your performance measures? Possibly, I think all of those are things to think about, and I'll be go into some detail on those. As far as the implementation roadmap is concerned, we will get to that on the next slide. But in terms of the timelines, it's effective 1st of April 27. Globally, the IFRS standard goes into effect on January 1 next year, which is Jan 1 27. But in India, given our financial year, we'll adopt it as it stands today from 1st of April 27. Again, what does that mean? And what does that mean, for example, in terms of comparative financial statements for the current year, which will need to be presented? What are the various reconciliation that may be required? Is again a topic that we'll discuss. And again, I think, like I said at the beginning, this is not just financial reporting. The impact goes far beyond that. Think about how if what the metrics that you've been using to present your financial performance now change or are consolidated in a part of your financial statements. Also, the fact that the face of the P&L will now look very different from what it has in the past will require some initiative and effort in terms of explaining this to external stakeholders. First, of course, internally, within the company, to the relevant decision makers, to the relevant consumers of the financial statements, and then externally to investors, to analysts. And Meenakshi will talk a bit about that and what are the various dimensions to that. Given the significance of how we prepare our financial statements and financial information, you need to also look at how your ERP may need to be reconfigured. And you think about chart of accounts, you think about from the underlying trial balance till the face of the financial statements, how will you need to now recalibrate some of these to be able to present the three categories and certain required line items on the profit and loss account, which is where Manish will come in and share some of his experience. If we move forward. This is the timeline that this standard has thus far followed. And like I said, we are right now looking at a potential application date of 1st of April 27. For listed companies, that means that you would need to, or to be listed companies, that would mean having to also present comparative periods for your previous, for this year, which will be the previous year come next year. And which is why I think this is a good time to start thinking about what this means for you and what are the various changes that you need to bring about. Clearly, the rest of the world will adopt this on 1st of January. And I think we will then possibly have the benefit of being able to see how the rest of the world has done that and possibly have some learnings from that. It's important to call out that the MCA notification for the standard is still not there. And one of the fundamental changes that needs to happen is the reformatting or the rewiring of Schedule 3. And once that happens is when the standard becomes a reality in its final form. But I think the expectation today is that largely MCA will adopt the standard in its current form. If that changes, of course, we will bring that to you as soon as we know. But currently, from what we hear, it's likely that the standard will get adopted in its current form. Let's move ahead. I think I would like to now bring in Sameer and possibly, before I do that, also go tell you a little bit about why this standard came about, right? I think the genesis again is a lot of criticism about the fact that there is the lack of comparability between how one company presents its financial statements versus another. And keep in mind that, globally there are no prescribed formats for presentation similar to what we have under Schedule 3. Essentially, one of the motivation for writing this standard was to enhance comparability. And this stemmed from the fact that a lot of companies were using various, I would say allocations or, different methods to calculate even metrics like operating profit. And this standard tries to sort of, bring about some uniformity in that. It also, like I said, I was talking about management performance measures. And for the first time, this brings about within an accounting standard the need to consolidate that presentation and information in one place, which is a good segue for me to bring in Sameer to talk about in a little more detail about some of these things and what you should be thinking about as you go about analyzing the impact of the standard. Over to you, Sameer.
Thanks, Karan. Thanks, and welcome everybody. We're going to get into a little more detail and possibly talk about how the PNL looks today, how it's going to change, what are the key judgments that are required for the standard to be successfully implemented, and all through as much detail as we can get to in a 1 hour webinar. We'll take you there. Maybe we can move to the next slide. All right, so I'll start with the left side of the slide, which is basically telling you exactly how the PNL looks today. This is coming from Schedule 3 Division 2, which is a non-NBFC, non-NBFC commercial entity PNL. Currently, it's a prescribed format of the PNL, and most entities in India would follow this. Revenue from operations, other income, and then we have a total income subtotal, and then we start with the expense side of the P&L. Expense side is also prescriptive. Generally, most companies would follow even the order. You would have cost of material consumed, purchases of stock in trade, changes in inventory, employee benefit expense, finance cost, depreciation, other expenses, and then the total expense. And then you come to a profit before tax. That's pretty much, after that, the tax expense, etc. Pretty much the standard P&L we've been used to for years. What's changing now is fundamental, right? Uh, and what you see on the right is a possible depiction of the P&L. It doesn't talk about the items in as much detail. It just talks about how the P&L is going to be categorized. We did talk about, operating, investing, and financing, and that is what's going to happen. The first category in the P&L will be operating, and operating would mean the revenue and the related expenses will both fall into operating. Now, how do you determine what is operating? Uh, that determination itself is subject to you determining what is your business's main business activity. Are you a lender that borrows and lends for business, or are you a commercial entity which IT services company or manufacturing company which sells goods and services, takes up revenue and expenses for in that context, and takes loans, and when they take loan they will have a financing, and not call it a not call it an item which is operating. So main business activity determination is the biggest first judgment in this standard. And I've been asked this before, can an entity have more than one business activity, main business activity? Yes, it can. If you are actually into multiple businesses, whether you are a group or a single entity, you could have more than one business activities. And in that case, that could be your revenue as well. So the first side of the P&L is the operating activities and the results from those operating activities. The subtotal below that will be called operating profit and loss, right? After that comes the investing category. Now, this is a defined category. Operating was a default category. That means if something doesn't fall in the defined categories, will also go into operating after you determine your business purpose. But investing is a defined category. That means that anything that is not your main business activity and is done for investing is going to be shown here. So things as simple as fixed deposits are investing. Things as complex as buying out properties which are leased out or having properties which are leased out are also investing. So income from FDs could go into investing. Rental income from properties, which will be investment properties basically, will go into investing. So the fundamental principle of investing is very straightforward. It basically requires an asset which can independently generate returns. So fixed deposit is the simplest form of example. You don't need employees to generate income from fixed deposit. So it's a investing. Similarly, building, which is a standalone building, being leased out, it can be investing. Of course, a word of caution, something that is your main business activity. If you are a real estate company which does leasing as a business, that may not be your investing activity. While the investments and the assets might be classified as investment properties. Okay. The next item is on the category is the financing. Now, financing is also a defined category. That means that anything that you borrow is financing. Now, if you see on the screen, there's type 1 and type 2 financing, and we'll not get into too much detail here. What it really requires is that any interest expense on borrowings or on operational assets, for example, operational liabilities, for example, trade payables. If your trade payable has extended credit term and or lease has a liability, has a interest, all of that will still go into financing, even if it's for your operations. So interest as an expense goes here, unless, of course, lending was your main business activity and you take the money that you borrow for specifically for lending as your revenue, and then of course the corresponding interest expense also goes into operating category. So that's the concept. Why is this different from cash flow? Very simple example. Cash flow is not accrued basis. Cash flow is today. You buy an asset, the benefit will come to you over the next 10 years. Hence, for buying an asset, cash flow calls it investing. uh, Buying an asset, depreciating while using its benefits, is operating that asset. So hence, if you buy an operational asset, while the cash flow will call it, investing, the P&L here will call it operating, the depreciation part operating. So that's the three main categories, and we wanted to cover that in enough detail. Uh, and then you go to the income tax and the discontinued operations. They have classified these in order and and put that on the face of the P&L, while it was more or less presented similarly within the current standard. So that's pretty much the new structure of the P&L: operating, investing, financing. Let's move on. These are some examples we took, and this is possibly a kind of a rapid fire, you could say a test session, and we can try our logics that we just talked about on these. Revenue from product sales. Now, products are your main business activity. Revenue from those products have to be in operating. Restructuring provision, right? uh, Is it operating, investing, financing? Well, it's a one-off item. You're restructuring. It doesn't fall into investing or financing. By default, it goes into operating. That's the logic. Impairment of a factory relates to an operating asset, goes into operating. If it was an investment property, it would have gone into investing. Share of profit from associates. Now, here the associate might be your operating associate, might be an extension of your business. But in your financial statements where you see associate as an investment, that associate is fairly an independent asset generating returns. In that context, it qualifies the definition of investing and it will show as an investing item. Interest on bank deposits, we've talked about it enough. It is all investing. Interest on borrowings. Borrowings is financing unless that is your main business activity to raise finance and lend funds. It brings us to an interesting concept. What if an entity was borrowing funds and using for its own, building its own office or administration block or something else, or just lease liabilities for a company which is in the business of lending? Treasury operations and own use funds are actually still financing. It's just that funds which are used in business or supposed to be used in business, borrowing those funds where your business is to lend will become operating activities. That is one place where you would have judgment to say what funds were borrowed for exactly what purpose. We will eventually obviously have a consistent view on that, but that's the kind of judgments the standard could bring in. Um, Interest on lease liabilities, always financing. Uh, Current and deferred tax, income tax category separately. Foreign exchange on trade receivables. Now, trade receivables is an operating item. Any movement on an operating item goes into operating. Similarly, foreign gain loss on borrowings, it's a financing activity. It will go into financing. Rental income on investment properties, most likely investing, unless that's the main business activity of an entity. So that's a crash course on what our concept of this standard is. Um, that's the operating, investing, financing. And now I want to cover quickly a concept called MPMs. Um, MPMs are management defined performance measures. These performance measures are actually triggered by um, public communications. That means that if an entity has published or is in the process of publishing a communication to public, uh, which has a parameter which is derived from a P&L subtotal, whether it's adjusted profit, adjusted EBITDA, adjusted net, adjusted operating income, anything like that, which is not agreeing to the P&L, but it is an item which is derived from the P&L, that item will be called an MPM under the scope of the standard and will have to be included in the financial statements. So basically, chicken and the egg problem for me to say, for you to be able to present such parameters in public, you have to have those in the financial statements at the first place for you to be able to present it. And those parameters will need to be reconciled completely to the financial statements, to the nearest subtotal in the financial statements, and that will be subject to a regular audit or review based on the results. So that's and I also want to talk about the fact that you know take example of a adjusted EBITDA. Um, if you put an adjusted EBITDA, you've adjusted some non-recurring items or specific items from that. You add back those adjustments. You reconcile that adjusted EBITDA to the nearest subtotal that would define, EBITDA on the P&L. Uh, Adjust the items which you have reclassified. Show the tax effect as well. That you did some adjustments. What was the tax effect of those possible adjustments? Show the NCI impact, which is the non-controlling interest or the minority interest, as we call it, and explain all these adjustments. How are these made, and then reconcile it with the financial statement. So it's a fairly, comprehensive reconciliation. It is not just saying that, this is derived from this and we had made these two small adjustments. It has to be step by step reconciled with the financial statements and explained. So that is going to put a lot of, pressure on the companies to be able to show items of adjustments in their public communications, whether they are investor presentations, etc. But I'll not take away the thunder from Meenakshi later, and she'll talk about it in more detail. As of now, we talked about all the three concepts of operating, investing, financing, and now we'll move to what happens if your financial reporting system does not support this kind of reporting. And I'll call in Manish for talking about what kind of changes might be needed to financial reporting systems for this standard to be successfully implemented and consistently reported.
Thank you, Samir, and thank you everyone for staying back. I think we have close to 700 people, and I know for finance folks, technology is slightly scary, and you often get reminded of the dreadful cutover and go live days. But things are not going to be that hectic on this. And also considering audience, we're just going to keep it very business centric as to what changes in ERP. And if you believe you have mapped your last chart of account segment values, you have to do a bit of work here. But just in summary, I think as Karan and Samir mentioned, there are changes to how transactions are now going to be treated. And also the fact that depending on the nature of business you are in, that will vary. So clearly, two, three things are there. A new chart of account, set of values have to be configured. You also need to understand that depending on now the line items which Samir was mentioning, the behavior or tagging that particular transaction to one of these three categories will also have to be defined. So here, your subledger accounting rules have to be configured just to make sure that your perspective business gets aligned to IFRS 18. And of course, after that, depending on what you're using as your financial reporting tool, if it is SAP Fiori or it is BI Publisher or FRS, etc., you need to make changes to that. What we strongly recommend is, because it's going to be evolving situation, as in, you test something, you realize you missed something, and then you again reconcile. And given the deadlines, it will take 2 to 3 good months to capture everything you have, do it in a lower instance, try it out, work with your accountants to validate your findings, and then, take a conscious decision to deploy. MPMs are something which, again, as Samir just mentioned, if you're doing it with an ERP, if you're using any narrative tools for reporting, this also has to be baked in very carefully, because these are the things which go out to your analysts and broader community. Few things we would like to call out here. If you are using a consolidation tool, as the initial wave will hit complex organizations, listed organizations. If you are a conglomerate and use a narrative reporting or a consolidation tool across group companies, you have to be more careful, because some of your group companies may fall under different categories, or treatment will be different. If one of yours is NBFC, another one is, a manufacturing, you will have complications that have to be further uh, tested and then consulted on. So the first step then will be you fix your ERP and then move into consolidation tools. Again, just from a summary standpoint, not to uh, put put more technology in accounting, what is important is, once you have analyzed your impact, considering the principles and classifications of IFRS 18, you need to start looking into new chart of account segment values, look into how your line items will be classified to certain categories. That will require, both of these will require changes in the ERP configurations. After that, the changes will move into your FRS, financial reporting systems. The two subtotals we talked about classifying this, few pointers are dicey affairs are forex and interest treatments, which Samir said in details. Those should be your primary testing area of focus. And then once this is done, and if you do deploy a consolidation tool, then you get into looking into all these at a group level. Reconciliation and audit trail is important. Auditors love to ask for audit trails. I don't think much will change here if you have configured things properly. But the comparative, period is something which will require a lot of work in terms of manual adjustments, and how do you take that duration out and help with moving to IFRS comparisons. So that's a bit about me. Again, it's to basically configuration changes in ERP and the presentation layer, which is more technical for FRS. These are two important things. And for diversified conglomerates, it's important that you have to make the same changes in your consolidation tools if you deploy any at the group level. On that note, back to you, Samir and Meenakshi, to take it forward. And we're happy to take any questions here. Please do feel free to put in questions in the chat box.
Yeah, I think we'll take questions at the end. We'll respond to all your questions. Please keep dropping them into the chat box, and we will definitely get back to you. If not live, we will respond offline too. But Meenakshi, maybe you want to come in now and talk about what does this mean from a communication standpoint, especially for companies that are listed or about to be listed, and given the amount of attention that this receives from SEBI. And I'm talking about KPIs and performance measures and how those are reported and the level of detail that SEBI now expects. Over to you, Meenakshi.
Sure. Thanks, Karan, and a very warm welcome to all of you. Thanks for joining us. I do hope that some of my colleagues from the investor relation side of things from organizations are also amongst these 700 plus people that are here with us for this conversation. This absolutely highlights the importance of these numbers being redrafted in a fashion which was, I think, one of the first slides that Samir presented on how the P&L is looking like and how it would look like. I think that's one of the questions also that we see in the chat box. Will the face of the P&L change? Absolutely. There is some creativity that will come in as per the conversations we've been having here. But it's important from a listed company perspective also, and I will also talk about unlisted, hopping on to what Karan said from a SEBI's focus on KPIs. But from a listed company perspective, I think it'll become equally important that once your finance teams have done the stating of the financials in the format which is more compliant with the requirement of Ind AS 118 now, how does that need to be communicated to investors? Because definitely there'll be a change. Will there be a change only in presentation? There'll be some group changes, if I can say so. And your EBITDA, if that was generally looking like something, I think there will be something from an operating profit level, from a financing profit level, and there'll be some additions and subtractions to be able to tie it up with what we were explaining to the investor community earlier. So that sort of a change will definitely come in. The explanations or the strategy or any forward-looking guidance, if you were providing earlier, that may have to be changed. The storytelling around that will have to be a little more modified. The other thing which is very prominent and across the last 35 minutes that we've been talking, you've been hearing about MPMs, which are management performance matrices. And that is something that people until now have been choosing according to what of course ties up to our business, but also what makes it look little good, right? So while EBITDA is what it is, if some sort of an adjustment can present a finer picture, which of course may not have been called out by the regulator, but we were given enough independence to kind of do it up in our investor communications, in our investor messaging, in our investor strategies, and that is what we were doing. And there we could find names like adjusted EBITDAs, underlying EBITDAs, normalized EBITDAs, and profits in the same line. There are more creative names also being used. I'm not kind of calling out all of them here, but we know them. Will they need some change? Yes, they will. They will need to be tied up back to your financials. They will also find up some space, in the notes to accounts or schedules there where we talk about them, so that there is absolute clarity, and they are both tied up to each other. So that the entire gamut of transparency, which is all about when we are standardizing the accounting standards, this is trying to bring about uniformity and transparency. That's what we are talking about, and which will eventually come out. So there'll be a lot of change that will have to be done. What is that, and how can we be geared up for that? We'll talk about it, but before that, maybe one thing also for the people who joined us from the private companies, unlisted companies, but who are looking at IPOs in the near future. There we tend to hope that there are certain KPIs which are used as MPMs for investor disclosures or board disclosures. But since there are no public investors at that point of time, organizations and managements are more comfortable using all sorts of KPIs. But I think if listing is on the radar, is on the cards, then you will also have to circle in the regulator's stance on KPI presentation as part of your DRHPs, where you will have to go 3 years prior, and whatever was being discussed as KPIs or shared as KPIs with boards and investors needs to go into your DRHP also. So what companies may want to choose to do is to marry down those KPIs, which could become potential MPMs, and start listing them out and working around them, and again tying them back to financials from now on itself, so that the pain that comes in after when you are closer to listing and in the DRHP period, that is resolved to some extent, we could say. Let's look at now what all changes will we need to do, and how will we be prepped up for that. Ankit, let's move the slide, please. So I think it's a step-by-step approach, but clearly what needs to be done, and what is the messaging from this whole new standard which is coming in, is to bring in more clarity and more transparency amongst information. The other thing, which I will go back to what Karan said when he started, was the the accounting standard IFRS 18, which is also coming into play from January 1st of next calendar year, which is financial year for most of the other countries in the world, and they will start presenting it, and we will follow from the next quarter on. So I think it's a very good space for, again, for us to kind of make ourselves comparable with the global companies, and for those companies which are operating worldwide and having global investors and analysts cover them. I think again it will be very, very suited for us, if with this adoption, to be compared with our global peers who would already have been on IFRS 18 one quarter ahead of us. So I think it will definitely boost up comparability for us amongst our global peers, and also bring in the much needed transparency when the MPMs etc. get tied up with your financials and financial statements. But what will it mean from us to be done now? I think all these MPMs, these adjusted figures, etc., that we are bringing out in our investor collaterals across, and that would not only mean the investor presentations, but it would also mean some, some fact sheets, or by whatever names we may call them, earnings release, etc. Kind of bring out a data sheet for them, what all they are. Then, as Samir also outlined, all of them will not become MPMs, right? So there's a definition, and you have to be profit oriented to be qualified as MPMs. So don't bother yourself too much, but only if they are in that criteria, you may need some reworking around them, because tying up them with the financials will be needed. So, tie up with your finance folks and sit with them to understand what all MPMs you really want to take to the market, to the investors. And, some of them may have to be phased out. So you'll have to look at that, which matrices qualify and which have to be placed. Some historical trends will have to be reassessed, because we have been, we've seen some kind of analysis which we show over the years, over the quarters. That will change with this new standard coming in, right? Your operating profit, which is now from quarter 1 of next year, may not match with the operating profit which we just disclosed for quarter 1 of FY27. So those historical trends will also have to be reworked once they've been audited for the prior periods. That change will need to come in. The storytelling or the messaging from a strategy perspective that you've been giving out to the investor community, you will have to check whether that needs some edits, some changes are required there. That will also be a very, very clear and watchful stay. You may have to retune your strategy and the way it has to be disclosed to the investors, and sit around with the management and discuss on that, because that will be a big, big game changer for you. So you'll have to bring out that. Also, as investor relation folks, I think there'll be a lot of messaging and learning and unlearning with the CXO community, with the spokespersons from the earnings call community, who will have to be prepped up on these sort of questions that you will have to be asked on the changes that have happened, and facilitate their commentary, and what should the messaging be like, and it should be a common thread of messaging across the organization. uh, and then, of course, dry runs to these kind of Q&A which can come up should be done. But I think most importantly, we will also have to educate our investor community, our capital markets community along with this, because this shouldn't come like a shock to them. Of course, they've also started their working around it, but specifically from your organization perspective, it shouldn't harm if you kind of try and work around some bit of working for them on what are the changes from your industry perspective, from the company perspective, and what is it that they need to be careful about. So probably you may try and work around some FAQs, typically for the analyst investor community, that they can start looking at and be more aligned. I think all of this and much, much more probably we'll also learn as we go through. Be very closely connected with your financial reporting folks, and try and see what are the changes which are coming in, and how can you kind of draft your commentary around it. But keep your friends, your investor fraternity in the loop, so that there are no surprises at the end of the day for them as well as for you. Tying it back to you, Karan, I think,
Thanks.
yeah.
Thanks, Meenakshi. So I think we've obviously given you a flavor of what the standard is going to do, or what you hopefully need to start thinking about. As Samir said, 1 hour is not enough. 1 hour is never enough to go into any detail on any topic. But the idea today was to at least get started with the conversation. So where do you go from here? And I think while we've laid out 7 steps, you could do it in lesser or more, but essentially the building blocks are really to start looking at what does this mean for you? Assess, really that what are the changes that you need to make. I think one of the key call outs for me is the ability to potentially present expenses, classified by nature or function. And I think that allows, and depending on which sector you're in, it could allow for a better, more accurate presentation of your, financial results. There's also an option to actually do a hybrid. And I think, as Meenakshi also alluded, you'll possibly learn from, the rest of the world in terms of what other companies in your sectors, what your peers, what are they doing? Because ultimately, bear in mind, the aim of this standard is also to enhance comparability, which may not happen in the first year, I would suppose, as different companies follow different paths. But over a period of time, I think that's the expectation. So really assess what this means for you. And I think some of the beyond just what the face of the P&L is, how will you enable it? I think Manish spoke about the technology aspects of it. Really looking at where there is a need to rewire the chart of accounts, but also to what Sameer said about some allocation that you will need to make. And we didn't talk about everyone's favorite question on depreciation and where that goes. I think it went missing from the left of the screen to the right. But items like that now need to be classified or split between categories. And I think that obviously capability may not reside immediately in the ERP. So you will need to pass certain adjustments. So that's not a rewiring, but that's an allocation. That's an example of an allocation. I think what are the metrics you want to put out to the world? I think that's obviously, if you already listed, you already have a good handle on that. But trying to bring it all together in one place in your financial statements and get them audited, because bear in mind, while the financial numbers have been audited, in case you're looking at metrics that are hybrid, by that I mean a combination of a financial and an operating metric, then the operating data may not have been audited. And that's again something you should start discussing with the auditors on how to prepare for that, how to enable that to happen seamlessly and efficiently. I think data, the ability to have data is always a challenge given the dimensions and the expanse of businesses. It's not going to impact every business the same. I think clearly, if you have one line of business, you're a single entity, possibly you're better off versus a conglomerate which has multiple business lines, multiple geographies. Within the same entity, you could have, multiple main business activities, right? And I think that's one of the things that Samir spoke of too. So again, I think that's what we would really recommend, that, get started with your assessment, look at, what this means for you, allows you a chance to possibly take, some calls on how do you present your P&L in a better manner, closer to what your actual performance is, and enabling that, with investors and analysts, as Meenakshi spoke of. I think that's a big part of it, again, if you're listed or about to be listed. And then, of course, I think we do have the handicap today of not having Schedule 3 notified, and lots of questions in the chat on what that means, and when will it come. It will come in its own time, but I think it will largely, I think, like we said, the expectation will follow the standard. So hopefully you're able to lift and shift what you assess today and then be ready by the time the notification happens. For listed company, possibly a bit more urgent, because when you present your quarters next year, you'll have to present the previous quarters. And again, I think that was also a question. I'm just trying to sneak in a few responses. This is from my colleagues, so please bear with me. And then I think maybe, like I said, as time goes by, keep a scan on what your peers are doing, what others are doing, and learn from that. Which possibly is a good segue to look at, where do we foresee most challenges in the implementation? And we'd like to do a quick poll for folks on the call. I think there's still about 700 people. You should be able to now see a poll on your screens, and we would really like you to choose, in your mind, in your opinion, where do you think most effort would go amongst the choices we've laid out. And these are classification adjustments, which is essentially where do you classify what. The MPMs, how do you define them? What is the governance, data quality, the controls around them, and eventually the presentation. Changes to the ERP, again, very significant potentially for some companies, especially if you have lots of allocations that you will need to do under the standard. Audit readiness, I've called out that, again, especially because some of this data may not have previously been within the perimeter of the audit. And investor communications, which is really how do you explain the change to the world. So we'll take a minute, and then we'll quickly look at what you think on the call, what folks on the call think about where and which are the biggest challenges. So we'll just wait another minute. Please keep typing in your questions. Like I said, we'll try and address some of them in the next section, but whatever we can't address on the call, we will get back to you.
Karan, some interesting questions came up, and I was also reading through, and I thought, good to clarify as they come. For example, there was a question on comparatives. Yes, March 28 is the first financial statements. The comparatives need to be restated. For listed companies, June 27 will be the first reporting, and the comparatives will be June 26, which will need to be restated. That was one. Second, very interesting is, does employee cost need to be split? Now that's one of the classification judgments, which is one of the challenges that you see there. Does employee cost need to be split? And we've talked about function basis classification. If you do function basis classification, yes, employee cost is split. If you're doing the operating, investing, financing, generally employee cost will not be split, because the definition of investing is that an asset generates income on its own. That's investing. Employees involved in generating income from that asset is generally not investing. So that is, administrative employees are all residual category, which is operating. So yeah, employee cost will generally sit in operating, is what the judgment says today. I think more exceptional items is again an interesting one. India loves exceptional items, right? As a country, we've had so many ups and downs. And where will the exceptional items go? It's going to be interesting, but since the PNL is broadly split into these three categories or four categories, you could say, including tax, the exceptional item, even if allowed to be presented separately because it is just an exceptional or a large and unusual item, will be within that category. So you will not get to set off exceptional losses from your investments to exceptional gains from your operations or vice versa. So some of that is something I thought I'll pick up till the poll comes over.
Maybe I'll sneak in one interesting question for you, Samir, before we see the results. What do you think is going to happen to segment reporting? Do you think companies need to revisit segments now, given you're looking at your main business activities?
It's a interesting one, and again, I'll avoid making loose statements, but uh, in India, we have not taken segment reporting always very uh, seriously because we come from a standard which was easier, and then we transitioned to Ind AS with CODM concept. Now, because anything which is not a business activity, qualifies as a primary activity, will go into operating other categories, investing and financing. uh, we may have to relook at how we define business segments, and large business segments might have to be relooked at. So yes, I would say that's a possibility. The standard does not require you to do that. It's a possibility. Of course, administratively, the disclosure of the segment will now have to be reconciled with the P&L results of operating and investing, etc., and hence the segment result will be a reconciliation with operating profit in most cases. So that's a administrative change that you'll have to do to the disclosure, not about the segment identification itself.
Yeah, I think you definitely need to reassess and be comfortable that your segments aren't changing, especially if you've
Correct.
got multiple business lines and reporting entities. I think the results are there. Hopefully, everyone can see them on the screen, and I think clearly, the judgment is possibly the highest impact area, and I think we would agree that this is what you need to possibly attack, with the highest priority. Because again, it may not always be simple. I think there were some interesting questions on the chat also on lease income versus lease losses. If we change the terms of the lease, for example. Similarly, on interest income and expenses, on investment properties versus the rent. I think that's a dimension that will definitely need some thought. Again, lean on what your peers do, given that we are going to be a quarter behind the rest of the world. But a good segue to actually ask a question from Manish. If I look at MPM governance and ERP data, I think those are collectively called out as the second and the third. But my question for you, Samir, to Manish, is really that, while we spoke of the technology side of it and the changes that the ERP needs, I think equally important, and that's a core ERP, right? But a lot of this data that constitutes the KPIs and the MPMs stems from operating applications that are not always linked to the core ERP, and again varies by the nature of business, but can be quite significant in terms of the level of data, but also varied significantly in terms of the level of rigor and controls it's subject to. So my question for you in a long-winded manner is, what do you think is going to happen with the dimension around internal controls relate from a tech standpoint, right? Given the now the closer linkages between operating data and financial data for some KPIs at least, if not most of them.
Yeah, very good question, Karan. I think the answer lies in governance. So if the data is not directly flowing through via ERP for some reason, and if there's a consolidation tool, then clearly, there needs to be a governance layer to ensure that right data is fed, or you need to build in system controls in the consolidation tool to validate those checks. Uh, and we all live in a complex world, so that's why it's a very good question, because there are instances in complex setups wherein directly the data does not pass through the operating data. So my 2 cents on this is, if the data is passed at a GL journal entry level, there needs to be some mechanisms you need to put in to bifurcate the data across these three categories. And that will be an impact on the integration layer. And that again needs to be thoroughly tested. It also then points out to an interesting question on the traceability.
Yeah, there was
So
a question on audit trail also, in fact,
Absolutely. So once you do something with the group data, what do you do? And again, these type of practical cases will come up, and that's why I said it needs to be thoroughly tested and configured and built at least 2 to 3 months. In some cases like this, it may be more. So the traceability here will be a challenge for a lot of organizations which operates a third-party operational management system and just does a journal entry, upload at the end of the day. Now, for things like that, clearly there will be some innovation that will come in. My 2 cents to this is it has to be broken up the journal entry feed into these 3, 4 categories. So there will be a toil on the third party system to give you that data. Otherwise, there will be a solution in data lake, and people have to then adopt, given the importance of this, dump all the data, get a traceability angle to it, and then feed the journal entry to GL of ERPs or directly to a consolidation tool. So it's going to be case specific, volume specific, but a very good question because it's going to happen and create some complications in the way currently ERPs integrate with operation systems.
Yeah, no, thanks for that, Manish. And but on technology, I think possibly shifting gears now to how we can leverage technology to help you deal with this. Samir, do you want to quickly come in and talk about how we are leveraging AI to help our clients understand the implications of what this means for
Yeah,
them? And for those
yeah.
of you who don't know this, Samir is our resident AI expert as far as matters related to finance go.
Yeah, so yeah, that's important, and that's a teaser. And I see, the meeting time getting over, and some people leaving. Not many, but few. And I would actually ask you to hold on because there's a important announcement that we want to make. The fact that we are uh, to all who have attended this webinar, we're basically offering to do a quick assessment. And if you see on the screen, we have a automated enabled form that you can fill. And if you upload your data, basic data, talk about your company, and upload your annual report and investor presentation if there is any, we can run an assessment for you using AI, provide you the results. This is hands-free completely. It's a system that's learned from the rules that we have generated, the assessments that we have done, and it will give you a overview of what's changing for you, how what are the main impact areas, give you a amber, green, red type of assessment, high, low, medium, and eventually also give you a PNL change of what your PNL was looking like and what your PNL could look like. Of course, this is not to be used for actual use in presentation, but it'll give you a fair idea of what your subtotals might be. This might be more detailed if you see on the screen than what you would generally actually present, but this shows you all the adjustments that you are expected to make. This is a AI based assessment with all its quirks and disclaimers, but I think we've got a good assessment here. So we would reach out to you with links. If you would want us to do this assessment for you, we'll be happy to do that assessment for you for free.
Yeah, we dropped the link in the chat box also for those of you who want to sort of use it now. But each of you will receive an email with the information so
Yeah.
that you can, if you choose to, provide your data, and we'll be happy to help. I think we're up against the clock, but I think again, an hour is never enough for any topic. But again, hopefully, it's the start of a conversation. We will keep coming back to you as we get more updates on this topic and we have more insights to share. But in the meantime, again, I would reiterate, we will respond to questions we haven't addressed. You should expect to hear from us. And feel free to reach out, of course, offline call any of us or write into us if you do have more questions and would like to have a chat around how to deal with this. So, with respecting everyone's time, thank you for joining us so much on a working day. The fact that 700 of you showed up shows me at least that this is a topic that requires some serious attention, and we'll be doing more of these in the future to keep coming and having these conversations with you. So, thanks to you and thanks to my team for doing this, and we'll be in touch. Have a great evening. Thanks
Thank
again.
you.